Sunday, October the 23rd. Thank you for joining me. The fourth video of my weekend webinar series. Okay, I've saved what I think is the best till last. This is the least confusing of all the markets that I follow, 21, 22 markets that I report on every day. Okay, sideways trends, choppy sideways, erratic trends is something I hate. But, you know, we've got to get used to them because they do happen. Now, a quick summary of what has happened. Yeah, here we go. Right, the weekly chart, we bounced from here, which was a surprise. It was the CPI number that triggered this. The CPI number was higher than expected Thursday before last. The market plummeted as expected, and then we suddenly reversed, and everyone that I spoke to, this caught everybody out. Certainly caught me out. I can't say that I expected this to happen. Strong recovery. Now, when we look at the daily chart, we had some indications that this would last. Big bullish engulfing candle on the Thursday. Then on the Friday, we had the big red candle. And that was me thinking, okay, bullish engulfing candle is not relevant. Don't pay too much attention to it. That's what I was saying over the last weekend. We're in a bear trend anyway. I didn't understand why we'd had that bounce. It was I then thought by the last weekend, it was a short squeeze that didn't last. And so we're going to continue lower this week. Lo and behold, Monday, massive bullish candle, recovering almost all of Friday's losses. Okay, confusing. But I'm thinking, okay, maybe that means we can push higher. Tuesday, we push higher through the 3,700 level. And I'm thinking, okay, here we go. We're going to at least test 38.10, 38.20, my resistance level. No, we just reversed the next day. So that was, let me see, that was Friday, Monday, Tuesday, Wednesday, wipe out Tuesday's gain and more. Okay, that's confusing. Thursday, we stage a recovery. I say, okay, and then we wipe that out and we close near the low of the day. So by Thursday, I'm thinking, okay, we've closed near the low of the day. This is failing. We haven't even managed to test the resistance level. We're back below 36,900, 36.90. This doesn't look good. We broke through the previous day's low and closed below it, which was 36.76. The close on the Thursday with 36.75, not looking positive at all. And then we go lower on Friday initially, okay, not unexpected. But what happens? We turn around, we get the biggest bullish engulfing candle, we get a big bullish engulfing candle. I can't say it was the biggest one for a while because we had a huge one on the CPI number, but yet another bullish engulfing candle. So was this confusing for me last week? Utterly confusing. You know, if you're taking it on a candle by candle basis, I had no clue what was going on. I'm going to have to admit it. I think I'm usually pretty good. I must be. I've been doing it 35 years and I've had this business for 15 years. And a lot of you have been with me a long time. But, you know, some weeks are going to be confusing and I can't do anything about that. Utterly confusing. Right. Where are we now? We've got a bullish engulfing candle. We closed at the high of the day. We closed at the high of the week after a very confusing week. When we look at the weekly chart, there we go. We've used the 200. Well, you know, that was my buy level around 36.00 with a stop below 35.70. Was it? No, hang on. Let me just rethink that. It was a little bit higher than that, 37.00. Anyway, look, the longs got stopped before we then rallied. Really frustrating. Right, enough of last week. We're back up. Now, we need to obviously break above the last week's high, 37.77. Get through there. We might finally hit my target of 38.10, 38.20. That for me is the key resistance level of the week. I have no idea why we stopped at 37.77. That doesn't make any sense. But anyway, that's what markets do. So let's see what happens there. The thing that I do like is I think, you know, having thought we were going to rock it last week and we didn't, then I thought, well, okay, we're in a sideways trend. And we were. These were my trend lines that kind of indicated it. But look, I think we've got an inverse head and shoulders pattern. And this would fit in quite beautifully with what I think. We've got now two bullish engulfing candles. And we do have what I think I can identify as an inverse head and shoulders pattern. Big left shoulder, head, right shoulder. And then a break above the neckline by the Friday close. So we've closed the day and the week above what I believe is the neckline to an inverse head and shoulders pattern. On the hourly chart, we've got the 100-day moving average crossing back above the 200 and 500. That's positive. 200-day moving average just starting to turn more positive. So if we can continue higher, we'll get the 200 cross above the 500 on the 1 hour chart. that will be positive. So look, I'm leaning towards a more positive outlook for the S&P this week. Those are my reasons, but we will ultimately have to get through 38.20 for a more positive outlook. Let's have a look at the other two. Nasdaq daily chart. We can go bullish engulfing candle on the CPI number, massive red candle on the Friday, made it look like we didn't need to care about the bullish engulfing candle. Monday opens up through the roof, completely now making back almost all of the losses from Friday and retesting the Thursday high. Some follow through on Tuesday, but we get a long lower wick and the market closes unchanged. How confusing is that? Then we try again on the Wednesday. No, red body, quite a big red body candle. We try again on the Thursday. We push up, reject it, long upper wick. So by Thursday night, you're thinking, okay, this market's tried to rally all week. Tuesday, Wednesday, Thursday, it's failed. I assume we're going to go down. And the bullish engulfing candle has not seen any decent follow through this week, and by Thursday night things are looking pretty bad. We've closed at the lowest point for 3 days. So I think we actually, what was the Monday close was 11,110. The Thursday close was 11,008. So we even closed below the Monday low on Thursday. You would think that's going to lead to further losses on Friday. Yeah, well it did. And then we got this enormous green candle, bullish engulfing, completely out of the blue, probably just as everyone had closed their longs, giving up on the week. So what does that leave us now after that very confusing picture? Well, a high of the day, not a high for the week. So we do need to get through 11,430, I would suggest, but we have broken above that trend line, and I'm going to go to the hourly chart now, and I'm going to show you what I think, again, is a more lopsided inverse head and shoulders pattern. Look, left shoulder ahead, very small right shoulder, but on the hourly chart, again, we've got through the 200, the 50, the 100, the 200, and the 500-hour moving averages. So we've cleared those, and we didn't manage to clear them all week. The 500-hour moving average was working as a pretty good resistance level for quite a while. We're through there. That's got to be a positive for the start of the week. We're through the trend line, which goes back to September. I need to redraw that, put that on the daily chart, and it's not quite accurate enough for me on the hourly chart. So if I argue that, well, whether it's a neckline or not doesn't really matter, because it's a pretty substantial trend line on the hourly chart. Been tested many times, 1, 2, 3, 4, 5, and then on the 6th time it broke. So this looks more positive to me. I would imagine it looks more positive to you too, for the reasons that I've given. Quick look at the 4-hour chart. Yeah, well, we're above the 100 period moving average on the 4-hour chart and the 50. We're approaching the 200. I'm not going to show you that. We'll be here all day. Back to the daily chart. That's my argument for a more positive outlook for the stock markets. This is, I believe, a correction in a bear trend, by the way. I don't think this is that. I don't think we've seen the end of the downside for the stock markets, but I think we do probably need to squeeze out some shorts, get up to test some resistance levels, and then maybe see a collapse into the end of the year, maybe after the election, who knows. I think the market needs a shakeout. There probably are too many shorts. Just, I mean, look at the reaction on Friday. The Fed said, oh, maybe we won't keep raising at 75 basis points. Maybe we'll cut that to 50. I mean, how is that possibly a good, how is that possibly bullish for stocks? We're going to keep raising rates. We're going to get them up to 4.5%, 5%. But, we're going to do it at a slightly slower pace than maybe you thought. It's just insane. It's clear that there are shorts out there that need to be taken out. I'm going to show you the bond yields in a minute. So, bullish engulfing candle for the Dow Jones, potential double bottom. I guess it is more, well, there is a very strong chance that it is. I don't know what I said last week, but look, bullish engulfing candle at the first bounce, bullish engulfing candle on the second bounce, and then what was that? Friday, Thursday, Wednesday, Tuesday, Monday. Okay, and then we had that. Oh yes, of course, the bullish engulfing candle on the second retest, on the retest of the previous low, gives us the potential double bottom. That was confusing with the red candle, but then we took it out with the green candle. This midweek shenanigans, which confused me. Now we've got the bullish engulfing candle. So the double bottom pattern there, we've got a double bottom in the Dow Jones. We've got a inverse head and shoulders pattern in the Nasdaq and the Emini. It all points to the fact that the stock markets are going to have a decent recovery this week, I think. Bought this time last week, but the market decided to give me a few punches to the ribs in the middle of the week just to confuse me. Okay, now Bond yields, I've talked about these all through the week because, of course, we need to follow them closely. They will have some reflection on the US dollar and probably the stock markets as well. Although bond yields rocketing and the stock market didn't really care. This is the weekly chart. I'm going to show you the monthly chart. You might remember that I had 397 to 410 as important Fibonacci resistance areas, coupled with some decent price action, which backed that up well through there on by the end of the week. 433 was the rate we hit for the 10-year yield, closed at 421. So we've closed the week above the important Fibonacci resistance areas. We've also closed above the, well, this whole decade, the 2010 to 2020 decade, we've closed above there now. So if you were looking at a chart that was decade by decade, we'd have broken above there. 401 was the high in 2010. So we're through that. You know, this is something I've put in another video when I've talked about inflation, I think. But look, from the period from, say, 2000, the decade before, from 2000 to 2010, interest rates averaged, well, 4% was probably the lower end of interest rates, and we're only getting there now. That period led to the housing bubble that created the global financial crisis of 2008, 2009. So interest rates were comparatively low at around that time, and we're only just entering that area of interest rate that we had in the first decade of this century. And it's crushing everybody. Mortgage rates are just crushing, as we try to fight inflation. But really, interest rates are only normalizing. We are not at a high interest rate historically. We are just getting back to where we were at the turn of the century when we considered interest rates to be cheap enough to trigger a housing boom. I know lending conditions went out the window, but still, it wasn't too expensive to borrow then. But it's amazing how it's way too expensive to borrow now, isn't it? I can't believe that people didn't realize that one day interest rates would go up. They were not going to stick around there forever, guys. That was completely engineered by the Fed, who were printing money and buying bonds and everything else that we all know about. Anyway, look, interest rates look like they're going to continue higher. There's no indication that they will turn around from here, although the dollar does look like it could have a little bit of a correction. And then there's the well, actually, look, we've got a minor negative candle. So, a long upper wick. We closed just down on the day rather, with a small red body. So maybe that's it. Maybe we'll correct down to around 4%, 3.95, and we'll see what happens at that support level. But I sure wouldn't be a big seller of bond yields right now. They look pretty positive to me. And eventually, I think the stock market will wake up after a correction and say, oh, hang on a sec, interest rates are going up still. This isn't actually very good in the long run. I've said enough. 12 minutes, that'll do for me. Right, I hope that's helpful. Any comments? If you're watching this after I've released it, a day or two after I've released it to my subscribers, I would value your comments. Have a look at my website, daytradeideas.co.uk. And please like, share, and subscribe. If you've got any questions for me, stick them in the comments box. I'll reply to them as quickly as I possibly can.